Hello and welcome to today's virtual Coffee Talk webinar. My name is Margaret and I will be your web host for today. I have a few housekeeping announcements and then I will introduce our speakers. In order to earn CPE credit for today's session, please stay connected to the webcast for the entire program and participate by responding to at least 3 of the 4 interactive questions. Secondly, there will be a course evaluation which will open in a new window upon exiting the webcast at the end of the program. With that, I'd like to introduce our speakers. Kevin Jacobs is a managing director with Alvarez Marsal Taxon in Washington, D.C., and the National Tax Office practice leader. He brings more than 15 years of experience in tax matters in both the public and private sector. Kathleen King is also a managing director and a national R&D practice leader with Alvarez Marsal in Washington, D.C. With more than 25 years of experience, Ms. King's projects have ranged from targeted consulting engagements designed to address specific issues to large-scale products utilizing engagement teams working concurrently in multiple locations. Robert Kovacev is a member of the Miller Chevalier Chartered. His practice focuses on federal tax controversy and tax litigation. He combines extensive first-chair litigation skills with substantive tax knowledge to represent taxpayers. And finally, Kevin DeYoung is a lead product manager with Wolters Kluwer Tax and Accounting. He will be showing us today how to find additional answers and resources using CCH Answer Connect. Thank you. And now, Kevin, take it away.
Great. Thanks so much, and thanks everyone for joining. Obviously, we could tell as the attendance and registrants is really high. This is a hot topic. Just one plug for the series as a whole is obviously we're always interested in hearing your thoughts on potential topics that you'd like to have covered. Our contact information is at the back. Feel free to shoot me any emails on topics. But today we're going to talk about 174, and obviously 174 is near and dear to many people's hearts and is causing a lot of angst as far as how to deal with it. So we're going to talk about what are the 174 changes, why is it now to the top of the list of hopeful changes that Congress will do, identifying and calculating Section 174 expenses, questions that people have as to how does it apply, what are future trends, and then as mentioned, Kevin's going to show us some Answer Connect information. So with that, Kathleen, if you want to start kicking us off to some of the changes in 174.
Thanks, Kevin. So we're going to try and cover fairly quickly the background items because we have a lot of the nuances in terms of how do we take this new changes and how do we implement from a practical point of view. Again, this is something that has been around for 5 years in terms of it coming on the books of and kicking off officially with tax years beginning after January 1st, 2022. The highlights again, there is now a requirement to capitalize and amortize research and experimentation expenditures. And so the big issues that companies are grappling with is, what is an R&D activity? What is an R&D expenditure? What are some of the mechanics in terms of the actual implementation of this incentive? And that's what we're going to try and cover today. From again, 30,000 foot level, we are having to break these R&D expenditures once they've been identified into domestic and foreign buckets because there are different amortization periods. We've got the 5-year period for US costs and 15-year for offshore or foreign expenditures. One of the questions that has been answered, and there are definitely more questions and answers at this point in time, is what do we do from an accounting method change perspective? There was a RevProc that was issued early this year, RevProc 2023-8, that addressed the basic changes in terms of what they're looking for in terms of a statement. I think some of the questions that are out there are, what if I don't have 174 costs on my 2022 return? Should I still include a statement? What should the form of that statement be? Again, if you look at the guidance, we think that it still makes sense for most companies to at least consider including that statement with the return. And I know, Kevin, that you've had some conversations with some folks at the IRS and Treasury in terms of what's required on some of those statements and maybe some of the special issues that they hadn't even thought of. So I don't know if you want to weigh in on that point.
Yeah, and thanks, Kathleen. It's definitely the case when you're thinking about it and you read this RevProc, it's straightforward, or seems to be straightforward for companies that have the 174 expenses and that are domestic. And that's going to be a key word, domestic. And the reason for it is when you start having CFCs or controlled foreign corporations, which are foreign corporations that are owned by a sufficient level by US shareholders, either because of direct or indirect attribution, you have to now say, how do you adopt this 174 method on foreign corporations? And unfortunately, the RevProc does not address this, because the RevProc is only dealing with, in lieu of filing a Form 3115, you get to file this statement. And they did that for both taxpayer and administrative convenience, because they didn't want to flood the system with all of these 3115s. However, it really is a trap for the unwary. And so if you have any foreign corporations that are going to be adopting this, you definitely need to start thinking about how the rules apply. Happy to talk to anyone that's in that position as far as what we're thinking of doing, but you need to be mindful of the statements that are required on top of a 3115 for foreign corporations that are adopting a change in method of accounting.
So again, definitely reference everyone to that RevProc, just in terms of the general statement. And as Kevin mentioned, just acknowledging that there are potentially some special issues for the controlled foreign corporations. A couple other just basic changes. The first is the definitional standard now that software development is per se of a 174 expenditure. And the reason that's important is because it really does impact a very wide range of companies now, even those that, again, historically have not thought of themselves as doing research. They may not have claimed a research credit in the past. And it also, for those companies that have previously claimed a credit, I think it could potentially broaden the types of costs and activities that should be included outside of your core R&D operations. It's because, again, things that maybe you haven't looked at because you thought it was internal use software, and maybe you didn't meet that higher standard that's required for those type of projects, those still fall under 174 and should be a part of your analysis. I guess the final point, Kevin, just at a, again, general level in terms of what's changing is that there is a standard in terms of, you know, what happens if the taxpayer no longer has the asset, and what is that asset? And I don't know if you want to just talk a little bit in terms of some of the questions that we've seen because of that change.
Yeah, so it's really interesting, and this ties into another hot topic that's beyond the scope of this presentation. But when thinking about the 174 cost, there's an outstanding question as to what does it mean that you have to capitalize it? Is it capitalizing the cost into whatever potential property that the R&D is generating? With that said, it's quite possible that the R&D doesn't generate any property. And so do you have one asset that aggregates all of your 174 costs? Do you have separate assets that are sort of labeled 174? And it becomes very important when you start thinking about if you're going to potentially undergo a change of control, which is really relevant for Section 382 purposes, and determining, do I have a built-in gain or built-in loss? And it's supposed to be done on an asset-by-asset basis. So again, not trying to go too deep in the weeds, but there are these questions as to what does this mean to say that I have to capitalize it? Does it generate a new asset, or is it an existing asset? What happens, for example, if you sell a company or you buy a company and there's, say, for example, a 338 or H10 election or 336E election, so it's sort of treated as an asset sale? Well, you really can't be buying whatever these 174 bucket pool of expenses are. So does that mean that the amount goes to goodwill? Does it generate a different intangible? So there's a lot more that's needed here, but unfortunately, we're just left trying to figure out how the best way is to handle it.
So yeah, that ties into the next slide in terms of, again, unfortunately, so we're almost at the end of May, and companies are well into their tax return compliance process, and there have been there's no new guidance other than RevProc addressing the accounting method change that's been issued at this point in time. The IRS has had a variety of individuals participate in different panel discussions at TEI and at ABA. And what we have learned over the last couple of months is, again, they are definitely working hard on getting a guidance package out there. I think originally, at least a couple months ago, we were hoping that maybe there would be some initial guidance coming out in the May-June timeframe. Definitely not going to be that soon. What we've heard is, they've referenced something near the year end, and we don't know if that's the government year end or the calendar year end, but they are definitely working to put forward a package. I think the big question marks in terms of what's going to be included in that whatever regulatory guidance is forthcoming, is it going to address some of the issues that Kevin was just talking about in terms of, especially from an asset perspective, how does that, since you can no longer dispose of it upon sale, what are the implications of, for other code sections in terms of how that should be treated? Whether those changes are going to be in the first round of guidance is to be seen. I think that what we're hoping to get some more clarity on within this initial round of guidance is, again, what is the definition and scope of research and experimentation activities? Some more guidance in terms of what is the concept of incident to the development of these activities. What does that mean from a 174 perspective? What is software development? We're going to talk about each of these points in a little bit more detail in the presentation, and also about some of the issues that we see out there from a contract arrangement where you have the one party that is hiring another to do research on their behalf.
Yeah, and just to chime in, as I've talked about in the past, I've been at A&M now for about 3.5 years, and before that I was at the IRS for 6.5, and a lot of people are scratching their heads saying, well, the law was in effect starting in 2022, why hasn't there been any guidance? And it's really hard because generally Treasury does not like issuing guidance on provisions that are possibly subject to legislative proposals. And so as a result of that, there has been quite a few different proposals, and it's been talked about whether or not they're going to make changes to 174 or not. And so as a result of that, it's sort of been a let's take a wait and see approach, because we have limited resources. Why should we possibly be investing them? In order to say, hey, let's focus on other provisions that are not going to possibly change. So where are we now? And you could see on this slide in 2023, there's 2 different bills that are out there. There's a Senate bill which last time I checked, people are saying has a whopping 1% chance of passing, and a House bill that has a possible 3% chance of passing. So if you want to win the lottery, you should if you win the lottery, you should also plan these bills to pass. But realistically, what it is we have seen an uptick in support to address the 174 provisions. Now, what does that mean? And what fixes do we think may happen, right? There's this ongoing calculus about what happens for a potential retroactive change. As Kathleen mentioned, this is in effect for 2022, so taxpayers have already started filing tax returns. And so if they do a retroactive fix to say, oh, well, we're delaying the effective date of 174 retroactively to any particular date, then all the returns that have currently been filed will presumably want to be amended, because then they would be able to take a deduction for these costs. How does that all play out? As it gets closer and closer to the final deadline, i.e. the normal extended deadline, it's less likely that they're going to do a retroactive fix. So if there is a fix, you're now watching between now and October, are they going to address it? And if they address it, is it going to be retroactive? We have seen a lot of push-pull, and obviously the debt limit is of front and center. And a lot of people have been saying, oh, well, originally they were anticipating that 174 as well as other provisions, for example, the 168K bonus depreciation and the 163J business interest expense, those three TCJA provisions might be addressed sometime soon. But as we're seeing the deadlock here, it doesn't seem that there's a path forward at this moment. But there's still growing momentum on these provisions, particularly 174, to address it. Now, with that said, we're going to launch the polling question. We encourage you to answer it. As mentioned, you need to answer them in order to get CPE credit. There's no right or wrong answers, but do you think that Congress will revert to pre-TCJA standards for Section 174? No, I think the amortization is here to stay. Yes, it will be eliminated before the end of 2023. Yes, but it won't happen until 2025 after the election, or not a complete reversal, but changes will be made. With that said, Kathleen, while they're answering the polling question, why don't we start talking about how to identify and calculate Section 174 costs?
Great. So, in terms of getting started in the overall process, I guess we always encourage companies that have previously claimed to the research credit to leverage those work papers heavily from a starting point. That should be a good guidepost in terms of the types of costs, the areas of the business that are performing R&D or otherwise connected with those R&D activities. To the extent that you have financial statement R&D that's being reported, that also would be a good starting point. Capitalized software costs for financial statement purposes. All of these are sources of information that, again, they're just guideposts. They are not going to be absolute. You certainly shouldn't just assume that just because you have costs that are reported for financial statement purposes that you then have to include those for 174 purposes, but I think it's at least a good framing for where we need to go with it. I think that one of the big things that you need to look at, especially as we're looking at these basic areas that we've looked at historically for credit purposes, is the cost accounts that are rolling to those cost centers, and trying to just get your arms around what more do we have to include for 174 purposes. And quite honestly, especially from a starting point, you need to make sure that you're prioritizing the big accounts. I wouldn't spend a lot of time, if there's something that's just a couple $1,000s and yeah, it's out there and wow, it's an interesting theoretical question, probably doesn't make sense given that especially for larger organizations with many accounts, you need to try and prioritize those. And just making sure that, again, you're taking a step back and saying, okay, we know that this is where we focused for credit purposes. What more should be included for 174? And probably the biggest area, if you look at the new areas, and again, this is the next slide, Kevin, is the foreign costs and the foreign research, because oftentimes, because it hasn't been eligible for the credit, there hasn't been a lot of assessment or review to understand how do the activities that are performed outside the US, whether from a contractor perspective, so if you have contractors that are over in Europe doing software development for you, I mean, this is a very common fact pattern. Oftentimes you wouldn't have asked the question, is part of what they're doing really more in the nature of support? Is it something that doesn't rise to the level of a software development type activity? Because again, for credit purposes, it's been outside the scope. Now you have these contracts and activities that you're going to have to give more analysis and assessment to figure out, okay, do they fall within the realm of 174? I mentioned the internal use software concept earlier. Again, many companies have not really looked at just the core of, you're doing updates to your general ledger system, or you're doing updates to your HR system. Oftentimes you don't look at what are the large implementation projects going on there, and they are now fully within scope of what needs to be assessed. And then there's the whole question of what additional expenses need to be accounted for. And I think that one of the question marks that we're looking at is, just because something qualifies for the credit, do those same costs automatically qualify for 174? And I guess the easiest example of that is, again, for credit purposes, there is a substantially all standard for individuals that are performing qualifying research. So if they spend at least 80% of their time performing qualifying services, then we can include 100% of those costs. Well, that means that there is 20% of the time that we're saying, or up to 20%, that is not qualifying time. But it's just because of that 41 gross up standard that we're getting to 100% of our qualifying wages for those individuals. That means that they may have been spending a portion of their time doing just purely sales activities and supporting the organization from that perspective. I think that some of the things that you should consider is whether some of those costs, so the payroll, and if you are using the qualifying payroll percentage as the basis to calculate the other costs within an R&D cost center, then you could be overqualifying all of your expenses if there are some amounts, again, that they're only being included because of this 41 gross up requirement. So what are the implications of that from a 174 perspective? And make sure that you're thinking about that. The other example that I've heard debated, and again, I can tell you that across multiple firms, this is still an area of debate, is what to do from a contract arrangement and a funding perspective when you have, again, controlled foreign corporations, foreign parents that are otherwise funding research activities. And there are question marks that, again, for credit purposes, if your foreign parent is providing funding for your research, because it's a control group worldwide test, you can ignore that funding. But for 174 purposes, there's a question that it's not the same standard, it's not the same threshold. There's a question whether or not that same conclusion should be reached for 174 purposes. So again, this guidance, there are so many issues that need to be addressed. I don't know if it's going to specifically touch on these, but I think those are some of the question marks that all companies should be looking at.
And Kathleen, just an interesting tidbit from the polling question. So 26% think that this regime is here to stay, and only 30% have said that it's going to change this year. So obviously, this is really important to keep in mind on the top of our heads as far as the implications. And I'm going to chime in and sort of diverge a little bit, because we got a question about, well, could we just capitalize it to circumvent this regime? And obviously, that's been a question that a lot of people have faced. And one thing, I'll just chime in to note and welcome other thoughts is, when you look at what it actually says under at least the 263 Cap A UNICAP rules, is it says that you can't capitalize something that's eligible for a deduction under 174. And so now it raises this fascinating question of, well, under 174, you have to capitalize it and amortize it. And so does the UNICAP provision only apply to the extent of that sliver of a deduction? And so you can you could move it out of 174 under the UNICAP rules for the portion you wouldn't have to deduct in the current year? Does the fact that it's capitalized just gets to move it completely out of the 263 Cap A prohibitions? And so this is just another area, just wanting to highlight, just to Kathleen's point, how there's so many different areas that we need guidance on. This is another area because taxpayers are really left trying to figure out what do they want to do and how do they want to approach it.
So the next question then is, okay, what is a 174 activity? And I think that the key, I guess, dimensions in terms of how you can approach this is how close is that activity to those things, again, that you've already concluded for credit purposes or for other, again, financial statement purposes, that, again, this is an R&D area of my organization. And it's nearly impossible to avoid getting into the weeds in terms of doing the analysis, both from an activity perspective and from an expense perspective. This is a very an accounting-rich analysis. You need departmental trial balances in many cases to kind of help with the analysis, to try and figure out, okay, how are all the costs rolling up? And so I think that, in the middle here, in terms of how do you start to parse things out, I think it's similar to what we have for 263 Cap A, where there's questions in terms of, okay, from an inventory perspective, are these costs related to the production of that inventory, or are they not? And so similar question mark here. Are these costs, are these activities related to research activities? And that is the fundamental question, that are they primarily for that purpose? There are a number of costs within a business, though, that are clearly production related. They're operations related. And I think so the question mark in terms of how that falls out, it has to be considered. So if it's truly for you are producing product, they're not pilot models, they're not things you're otherwise going to try and include for research credit purposes, then those are costs and potentially departments or areas of the organization that should be just set aside. Because again, in order to manage this process, you have to start to say, okay, this is outside my scope. Sales and marketing, again, unless you are including some of those sales personnel, a portion of their time to support R&D activities, again, that would be one that I would say, just from a top side, those are things that you would try and exclude. Again, I make it sound like it's easy to make this assessment in terms of what's production versus operations, especially think of like a SaaS company. So they have a software as a service. It's a large online platform. Companies or their customers, clients, they assess that platform. A lot of those costs, it's just the normal operation of that platform. So it's really nothing to do with the R&D. And some of those costs may include things like cloud hosting services. It may include licenses, again, just to operate the basic business. And it's that, and trying to parse those portion of those costs that, again, relate to just the normal operations versus the improvements that are the crux of what we're looking at. I put it on this continuum because I think there are certain costs, again, that are clearly production or clearly sales. Those are ones that are likely not to be reported for 174 purposes. The more you move towards the salaries and benefits of the R&D personnel, those are highly likely to be 174 costs. I think there's a number of expenses that fall in between the sales and marketing and the direct material, direct labor costs. A lot of these G&A type costs that get a little bit more questionable. One example that we've seen is it is not uncommon for rent or facilities charges to actually not hit directly to an R&D cost center. It may sit within just a general corporate account. And I think that there is a high likelihood that at least a portion of those costs, those rental costs, those facility charges may relate to R&D. And so just as you're trying to figure out, okay, what G&A costs should be included or excluded, I don't think it's as simple as just saying all these costs should not be reported. I think one example from, again, referencing section 41 that I think is at least a way to think about it is that there's an example that says that if you have someone within the payroll department that is cutting the checks, writing the checks for individuals in R&D, that is, for at least for credit purposes, that's an example of somebody that's not directly supporting R&D. And so that would be an example of a G&A type cost, a payroll person writing a check for someone that just happens to be in R&D, but they have absolutely no influence or impact on how that person performs. I think that would be an example of a G&A cost that, again, without guidance, it's hard to say how far they're going to take it, but that would certainly be a pool of costs that I would try and exclude. So we have a number of these, again, mixed use departments and accounts. Again, from a software perspective, it can be license charges, software licenses that you have to look at and evaluate. Again, what is the primary purpose? And it's probably an allocation. There's a lot of allocation that need to be determined here. From a rent perspective, again, with no guidance out there, you can use pretty much any reasonable method. So if you can come up with a standard that makes sense for your organization, maybe it's based on head count, maybe it's based on square footage. So if you have a factory and a large portion of your factory is, from a square footage perspective, is related to the is related to production, then maybe square footage is a more favorable way to think about how to allocate rental charges. But again, you have to come up with a method that makes sense for your business and the activities that are taking place. We don't have a lot of time to talk about it today, but Kevin mentioned earlier the UNICAP interactions that might be out there. 280C for the credit is a big one that has to be accounted for, but a lot of nuances there as well. So if we dig into a little bit more detail, again, are just practical suggestions. I would say definitely, to the extent that you can get the general ledger trial balance information broken down by department or major projects or cost centers, that's going to help you narrow down which costs are really at play. Because at the end of the day, it's those costs that are flowing to R&D, engineering, and technology groups that are really going to be the primary focus and potential 174 costs that are at play. That's not to say that within a production organization that you don't have a manufacturing engineering team that is working on process improvements, that you would need to account for some of those time. I think you have to be really careful within the production environments, though, because just because you have a manufacturing engineering pool that maybe accounts for 7% of your labor costs within that production area, that doesn't mean you need to pick up 7% of all the other costs that are within that department. Because a lot of those costs, again, they are primarily for non-research purposes. I think that you have to consider what other costs within those non-core R&D groups need to be accounted for. Things like, again, just general help desk support, training. There is a old, I think it was an FSA that was out there that put training costs as being something akin to a general management type of expenditure that doesn't fall within 174. So there's some actual, old guidance specifically on training that would allow you to exclude those amounts. If we, go into, I think it's the next one is your next polling question, Kevin.
Let's launch the next polling question of what has been the most challenging aspect of the transition to 174 amortization, identifying new activities, new expenditures, tracking the costs, or no significant challenges. And it'll be interesting to see how that all plays out. But I guess while doing that, Kathleen, if you want to keep discussing some of the key questions, I know we've already highlighted some of them, but.
Yeah, so the key questions, again, from a guidance perspective that we really want is, just a little bit more definition in terms of, what is the expectation in terms of what's in scope for our research and experimentation activities. Again, this whole concept of incident to, how close does the cost need to be to the R&D activity? I would tell you most companies, as they're looking at a lot of general, especially corporate level G&A costs, those amounts are not being included for 174. Now, when the ultimate guidance comes out, there may be a different viewpoint in terms of how they should be applied, but again, definitely a big question mark, especially with some of the mixed use type departments. And what this slide is showing us is that, in particular for R&E costs, what if you have purchased intangibles? You bought a business, they had a important patent cost that, or maybe it was, you acquired workforce that was related to your R&D activities. Is there a portion of the amortization that needs to be included for that? I think you have to analyze, again, what is the impact of that expense on the current R&D efforts, both from an activity and an expense perspective, to figure out whether a portion of those costs should be included. I know that I get a lot of questions on what do I do with my travel costs? What do I do with my meals? And I think that you have to consider, I don't think it's fair to say that travel costs should never be included as a research and experimentation cost, but I'm certain that there are elements of travel that also should not be incorporated into that bucket. Kevin, can you, yep. So I want to talk a little bit about software development, because this is, again, a big area. And there are some IRS officials that have at least given some high-level guidance in terms of their views on software development. Again, they have pulled back RevProc 2050. That used to be the standard from a software perspective in terms of what should be expensed or capitalized. But I agree with the IRS. I mean, again, that was 2000. That was before the iPhone. That was before really the major growth in online internet activity. Obviously it was around at that time. It was before Chat GPT. It was before artificial intelligence is becoming a normal part of businesses' everyday activities. And so the discussion in terms of technology charges and what should be included really need to be updated for where we are today. I think that you have to look at, especially for technology businesses, look at some of the common charges that might be out there. I think that what you might find for many of these is that there are a lot that are mixed use, again, as I was referring earlier, meaning that it's not an all or nothing in terms of whether they should be included, and that includes salaries. I think you have to consider, are there some just very minor bug fixes? Are there updates to reports? Is it installation of off-the-shelf system? Are you just doing configuration of software as opposed to truly developing software? And I think all those are examples of IT type charges that may not be accounted for. Cloud costs are huge. And I think that one way to think about cloud costs is that a lot of the vendors can provide an analysis as to the portion of those cloud costs that relate to development servers in the cloud. And so perhaps the development server would be a way to, again, allocate those cloud costs between those things that are developmental and those that are not.
So one thing that also has been stymieing a lot of people is how should costs be accounted for in contractual arrangements. And this really is one of the hot topics that Treasury and the IRS has identified, like we need to get guidance out, and we need to get guidance out fast. And in essence, what it is, okay, I am going to need to perform some R&D expenses. And so now I sort of outsource those expenses, and I outsource them sometimes to a related person, sometimes to an unrelated person. And the question becomes, that unrelated person that's performing the actual research, are they subject to 174? Because I am going to be subject to 174 for the amount that I'm paying to them. And so it's possible that the same costs, right? Because I'm in essence reimbursing the person that's providing the research, their costs. So the same costs are going to be subject to 174 twice. And so Treasury and the IRS have identified this as a highly factual issue that they need to resolve. In the initial case, it's the view of, well, we shouldn't have the same cost subject to 174 twice. It gets a little bit harder, though, when the person that I hired now has other rights. Is it an outright payment, or do they have sort of this vested interest in the performance of whatever they helped research? And so it really becomes a very fact-specific position. And so if you're in these positions where you're doing contract arrangements, which is quite frequently used, speak to your provider. We're happy to talk to whoever it is to start walking through various positions. But I'm also mindful of where we are in the presentation, and we're going to launch the next polling question, and then which does, do you believe your work papers are sufficient if your 174 amortization is audited? Yes, no, or maybe. It'll be really interesting. I don't know how you can gauge it without IRS guidance, not trying to sway the answers here, but there has been a lot of interest as to what is going to happen in the market and what is the IRS going to do, especially in light of the limited guidance we have now. So I guess, Robert, if you could start talking while they're answering the polling question of, can you help predict the future trends in 174 audits and what you're seeing and going from there?
Sure. Now, in some sense, this is uncharted territory, because for years, no one really cared whether something was categorized as 174 versus 162 or 263 Cap A. And the only time when 174 would come up would be in terms of the research credit, because qualifying as a 174 expense is a necessary, though not sufficient, requirement to qualify for the Section 41 credit. Now this is going to be an issue, because there will be real money at stake whether something should be amortized under 174 or could be immediately deducted under 162. And this really hasn't been an issue since 174 was enacted back in 1954. So I think we're going to be seeing an increased amount of disputes about that. We do know something about the IRS's approach towards the Section 41 credit. I think that will inform how the IRS approaches these. We know, for instance, that the IRS has identified research issues as a LB&I compliance campaign. We know that the IRS has imposed central planning on the audit system. This is something that we've seen through research credits over the past several years. If you've paid attention to the strategic operating plan that the IRS just released, which is how they're going to spend their $80 billion windfall, one of the main themes of that in terms of enforcement is increased centralization. And that's going to mean centrally directed enforcement priorities. It's going to mean IDRs that are dictated from Washington. It's going to mean that field audits are, auditors are going to be constrained in what they can and can't agree to, what they can and cannot do for you. And there will be increased use of one-size-fits-all audit approaches, as opposed to audit approaches that are tailored towards a taxpayer-specific business or other situation. So these are things that we know are happening in the Section 41 space and will inevitably happen in 174 as well. So skipping to the next slide. So what are we seeing in Section 41, and what can we predict in 174? One thing which we've seen is the case Little Sandy Coal, which is a case that was decided in the tax court and then recently affirmed by the Seventh Circuit. It was about a shipbuilder and research claims. And the main focus of the case was about the substantially all test and whether 80% of the 174 expenses constituted a process of experimentation as required by the reg. If you have a hammer, everything starts to look like a nail. So if you're the IRS and you have a big IRS win in Little Sandy Coal, everything suddenly looks like a substantially all case. So we saw a lot of IDRs popping out of nowhere in research audits saying, oh, we don't think you've met the substantially all test. Why don't you tell us about the process of experimentation and have you met the 80% test? And that's something which I expect is going to continue. Stat sampling is something which has become much more prevalent as the taxpayers have had more complicated research. Back in the day, it was possible to reason with audit teams. You could do a judgment sample. I'll just take the top 20 projects by revenue, and we'll just look at that. Increasingly, the IRS has insisted on a actual statistical sample backed up by some sort of statistical expert's opinion that it is actually a representative sample of the entire body of research for a company, and there's a lot less of the old flexibility which we were sometimes able to have. As always, documentation is key. The first line of defense for an IRS auditor is always, well, I don't think you substantiated this. And I have seen too many audits where the revenue agent's report comes back with a big fat 0 for a Section 41 credit, and with a simple explanation, you just haven't substantiated to my satisfaction that there was any qualified research at all. And then kicks it to appeals, and then you have to fight, there or in court. So please keep your records, make them understandable. Understand that people are going to leave, and you need access to information that you can turn over to an auditor 3, 4, 5 years from now, and you need to defend the substantiation, not just for the research credit, but also for your 174 expenses. Last slide for me. There's a lot that we don't know, but I think one thing that we can suspect, just based on some comments from IRS officials, it's this. If there's an expense which could be 174 and could be something else, like a 162 expense, or perhaps a cost of goods sold, seems pretty clear the IRS is going to take the position it has to be 174. You can't immediately expense it under 162 because they're aware of this amortization. This is an interesting dilemma for the IRS because one of their favorite lines of defense in research credit audits is to say, well, these aren't 174 expenses. You haven't met the 174 test. So we will have to see how, in practice, in audits, the IRS deals with that tension. At the same time, taxpayers have to be aware of the possibility that they could get whipsawed by this. If you say it's a 174 expense, and then the IRS disallows it, in a research credit audit, have you preserved your right through a protective refund claim or some other way to say, okay, well, if I'm wrong about that, then these are 162 expenses, and I can immediately deduct them. So that is just another layer of complexity that's added to the audit scene in this area. Because there are 5 years, actually 6 if you think about it, of at which a 174 expense must be amortized, that means that you are at risk for 6 years worth. If the IRS doesn't pick up on a 174 issue in year 1, it could still pick it up in year 2 or year 4 or even year 6, and could have it disallowed. And while they can't go back to any years that have been closed, the fact that that you claimed it first in a closed year doesn't mean that they can't disallow it in one of the subsequent years while the amortization is taking place. So you can't jettison your substantiation once just statute of limitations ends for year 1. You're going to have to keep it through year 2, 3, 4, 5 until that last year's statute expires. Because any time during that period, you remain at risk. So that in a nutshell is the audit and controversy space in 174. And I expect that we'll be seeing a lot of activity over the next several years as more guidance comes out and as the IRS actually begins to start these audits on the ground.
Yeah, no, that's really helpful and greatly appreciated. A few other tidbits to add on to what you're saying. The other thing to be mindful is, as far as statutes, is if you actually have a net operating loss, it's not just a matter of saying, oh, okay, the statute for year one has now closed, because as long as you have that net operating loss, they're able to actually adjust retroactively the amount of the net operating loss that was generated in that year. And so it's for companies that have large net operating losses, you have to start thinking about what are the implications of this. The other fun thing, and we've talked about the interplay of this and other provisions, is, well, how does this interplay with, for example, CAMT, the book minimum tax? And so realizing you have this capitalization and amortization for tax purposes versus how is it treated for book purposes, and what does that do? There's going to be a lot of interesting audits. We've already talked about, on another virtual coffee talk, how is CAMT even going to be implemented is another thing. But just jumping back to the basic changes that Kathleen highlighted, documentation is key. And as noted on the slide, there is a difference between R&E performed in the US and R&E performed outside the US. And this is something that companies that haven't started doing this process have now said, this is going to be an undertaking, especially when we're talking about to what extent you can identify the activities and identify the expenses. And so, work with professionals. Kathleen is working on doing documentation and trying to make sure that companies are really suited, as noted, so that way when you do get audited, you can hand these things over and say, this is the methodology, this is what we did, this is how it's going. Unless there's other thoughts, Kathleen, do you have anything quickly to add? Robert, anything else? Great, so with that, we're gonna let Kevin come on and he's gonna show us Answer Connect.
Excellent. Thank you all. It was great information. Margaret, if you would mind passing over to me the screen share. Just want to confirm CCH Answer Connect is up and running for everyone.
You're good, Kevin.
Excellent. Thank you. Yeah, a lot of guidance coming out on this, a lot of uncertainty. And as we think about looking at CCH Answer Connect and how we can tie everything you've heard today in and how you're going to maneuver and manage and just address all the different variables that are associated with that, want to take a couple of minutes to look at how CCH was designed, CCH Answer Connect was designed to really assist the researcher be able to take all of this information that's going to be coming through and put it into a system that allows you access to all of that content without having to look in various sources, various spaces of information to basically put all of this together. So we're going to take a quick search here in CCH Answer Connect under our research and development. I'm going to start out by simply just keying in a very basic search for research. And you'll notice what CCH Answer Connect begins to do is populate content based on the specific or potential areas that you as a researcher would be interested in looking at. We have some Q&A information. We're going to give you high-level overviews of some of the various topics that relates to research and experimental costs, research credits, as we've heard today as well. We've also got several topical areas that we've put together within CCH Answer Connect in terms of addressing this issue from a topical overview space to deal with the specific issues that were discussed earlier during this presentation. So for today, we're actually going to go into our topic page as it relates to expenses, research and experimental expenses under the new code section 174. I really want to talk about how we've created a workflow and a process for you as a researcher to be able to aggregate all of this information into a single location without having to use various sources or click on various links to go elsewhere within a tax research platform to pull all of the content together. So as we take a look at this research topic page for the research and experimental expenses, I want to focus a little bit on this left-hand navigation pane, which will walk you through this page where, again, we've aggregated the content as it relates to this specific topic. And you'll see we're going to have some discussions on the post-2021 research and experimental cost expenses. We've got some great hyperlinks out to code sections available through here, some comments, some planning notes. I'm actually going to scroll down slowly through this because several of the different areas that were discussed here, for example, foreign research, how are you going to handle this once additional guidance is given on this in terms of those foreign research expenses that are incurred? We're going to give you that information here as it talks about the 15-year amortization. Kathleen talked a little bit about the software piece. We're actually addressing that in this topic page as well. You're not going out and having to pull all of this information together through various sources. We've heard about the change in accounting method in terms of some of that information as well, and the links directly into the new revenue procedure that's come out, giving some additional guidance in terms of how that can be handled. So again, we've pulled and aggregated that all together. I'm going to kind of scroll down here a little bit on the research pane here, talking again into the research expenses section of this topic page. Trader business, experimental and laboratory census here, all of this information pulled together for you. One of the other items that's going to happen is, as this information or additional guidance come out, how are you going to be able to keep on top of it? One of the things that we've begun using in the past 18 months or so is our client impact event, where the editorial team will take this information as it comes out. So when the new guidance comes out, we will create a new client impact event where we will actually walk the researcher through. This is from late last year. The specific areas related to this. Again, we're in that topic page presentation, so we're going to give you that overview. We're going to walk you through a client application, a client profile. If there's any additional recommended topics, as you'll notice, this one will link back into the topic page we just came from. If we're going to make links directly into a specific code section, we're going to give you that information here. Client letters, communication tools, all of that is located within this one page. As we scroll through the remainder of the topic pages, we're going to pull in the key primary sources, and we're going to link to this in a minute just to talk about how that is all laid out. You also have access to the regulations and rev procs here as well. If you need to see if there's been any state activity in terms of code section 174, have there been adoptions, have there been modifications by any given state, we're going to give that to you as well as any practice tools. How are you going to communicate this out to your clients, or within a corporation, how are you going to present this in that environment as well? And again, all of this is located here on the left navigation. There are news. Again, so if news is pushed out to you, we're also aggregating that here in this topic page, so all information is given in one location. As we jump over to the code section, if that's the methodology that you prefer doing research, you want to go directly into that code section, you can simply go directly into 174. And again, here we've aggregated all of that content for you in what we've defined as our 360 view, meaning all content related to code section 174 is now located in this tabular view across the top. So you can take a look at your code if you want to take a look at the specific regulations tied into 174. Again, everything has been aggregated. There's no need to go to different locations within the website to pull that information. If you want to take a look at the CCH explanations for further guidance, and these will be updated and enhanced as additional guidance comes out, you have the ability to take a look at that information from this page as well. Moving over to our cases and administrative guidance, we talked about and heard about one of the new Rev Procs. This is where you'll find that information under Rev Ruling 2023. You have that. If there's the procedure 2023-11, all of that again has been aggregated here for you as a researcher. We talked again about tools. We've pulled those into this location similar to how we had done in the topic page. And then finally, the ability to, from this location, still be able to go out to the various states to find out where their stance is at on code section 174 currently. So again, very high level overview of CCH Answer Connect. Would love the opportunity to discuss further if anyone is interested. Look forward to hearing from you. And with that, Margaret, I'm going to pass it back to you for the final polling question.
All right, that wraps up today's webinar. I want to thank everyone for their participation. CPE credits will be posted within 2 to 4 business days. You will receive an email with a link to the course evaluation and your certificate of completion. Today's webinar has also been recorded. You will receive an email with access to the link of your recording. Thank you for attending and have a great day.